Good evening, everyone. I am Monica, working as an assistant professor in MBA department at BVC Institute of Technology and Science. Today, I am going to discuss about sources of finance. Sources of finance is the most important objective in financial management, and it is also a important decision in financial management. So, we are moved to the main topic, sources of finance. After estimating the financial needs of the company, the financial manager must decide about sources of finance. Finance manager can collect finance from various sources like debentures, bank loans, shares, lenders, and etc. The type and amount of funds required usually different from one business to another business, which means if the size of business is large, the amount of funds required will also be large. If the size of the business is small, the amount of funds required will also be small. For example, the financial requirements are more in manufacturing businesses as compared to the trading business. Manufacturing business means it is a business that uses raw materials, parts, components to assemble finished goods, which means it is a business like to converting the raw materials into finished goods. And trading business is a business to buy finished goods at one place and sold at another place. The business needs funds for longer period to be invested in fixed assets like land, building, machinery and equipment, etc. Sometimes the business also needs short-term funds for the maintain day-to-day operations in the organization. Based on these sources of finance can be classified into three types. First one, short term sources of finance. Second one, medium term sources of finance. And third one, long term sources of finance. Short term sources of finance. It is also called working capital management. This is a capital required to meet the day to day operations in the organization, which means to purchase of raw materials, payment of wages and salaries, and payment of electricity bill and petty cash expenses, etc. Those loans are obtained usually 1 year. The repayment period is these loans are 1 year, less than 1 year. Short term capital is divided into six types. First one, trade credit. Second one, commercial paper. Third one, installment credit. Fourth one, letter of credit. Fifth one, certificate of deposit. And finally, accrued expenses and deferred incomes. Well, coming to the trade credit. Trade credit is the arrangement between businesses to purchase goods or services without making immediate cash payment. Commercial paper. Commercial paper is a money market security instrument issued by a large corporations to get money to meet the short-term debt obligations in the organization. Short-term debt means purchase of raw materials to pay wages and salaries and petty cash expenses. And installment credit. Installment credit is a form of finance to pay for goods or services over a period through the payment of principal and interest in regular payments. For example, if John borrows to buy a new car at 30,000, the lender might set his payment at 665 per month for 48 months. That means that over the next 48 months, John payment will equal to 31,920 rupees. 30,000 is the principal amount and 1,920 is the interest amount. A letter of Next one, letter of credit. A letter of credit is an arrangement whereby a bank helps its customer to obtain funds from its suppliers. When a bank opens a letter of credit in favor of its customers for some specific purchases or purposes. The bank undertakes the responsibility to honor the obligation of its customer when the customer fails to do so. Certificate of deposit. Certificate of deposit is a financial product commonly sold by banks, financial institutions, and credit unions. And interest rate is fixed. And time period for certificate of deposit is one to within 1 year. Next one, accrued expenses or deferred incomes. Accrued expenses represents a liability that an organization has to pay for the services or goods which is already received. Example, salaries, wages, interest and taxes. Next, deferred incomes. Deferred incomes are incomes received in advance by the organization for supply of goods or services in future period.